Hello and welcome to Financial Revelations. I am your host, David Safransky. Welcome back. I just got back from a week in Aruba. I did the radio show from a balcony in Aruba, and they were complaining about how loud the birds were chirping. It just was a big problem for them. I felt bad for them. One, because they weren't in Aruba, and two, because they had to be hearing all these tropical birds going off for an hour. It was kind of interesting. So I'm back from Aruba. I got a little sun kiss on me. And of course, I worked when I was in Aruba. It wasn't just all vacation, beaches and Mai Tais and scuba diving. I at least worked every day for a little bit. And as I take these vacations, or I take a vacation, one of the things that I do is I kind of use it as time to recharge my batteries, but also think about what's going on in the economy right now and what we need to talk about, not only with our existing clients, but on the radio and also on the podcast, Financial Revelations. And the one subject that keeps coming up more and more and more is interest rates. So I spent a little time diving into interest rates and how they've responded over the years. And what I've come up with is I want to make it an easy analogy for us to kind of grab onto. But I want to explain there's two reasons why interest rates rise in the market in general. Of course, there could be more, but in general, there's two reasons why they rise. One, the economy is improving and easy money policy or the accommodation from the Fed is no longer necessary. When that happens, what the Federal Reserve does is they raise borrowing costs for banks on overnight loans. Every bank in the Federal Reserve System has to have a certain amount of deposits at the Federal Reserve by about 7 o'clock every night. And they do it all electronically now, so there's no armored cars moving or anything like that. But if they don't have that certain reserve requirement at the Federal Reserve by 7:30, they have to take an overnight loan from the Fed. And the reason why they would do that is because the cost of the overnight loan from the Fed is way less than what they're going to make loaning that money out for cars, houses, boats, college tuition, things like that. So there's a spread there. And the Federal Reserve has kept this rate to loan banks overnight about 25 basis points. Well, if you buy a used car right now, you're paying 4.5. So the bank will be at zero with the Fed if they could have all that money loaned out. That's how banks make money, is they loan money. But when rates rise because the economy is improving, it's generally seen as a good thing. As long as the Fed is telegraphing their moves, so they're telling the market what they're thinking, and they're moving slowly. When the Fed moves too fast, it scares the snot out of the markets, and that's when you get some wild swings. So when rates are going up because the Fed is raising rates because the economy is improving, generally seen as a pretty good thing. Now, we'd always like easy monetary policy because you can buy more house and you can buy more car, and it tends to keep money moving. But at some point, there's going to be too much money in the system, and it creates the second reason why interest rates rise, and that's inflation. And inflation, at its very basic term, is too much money chasing too few goods. So there's way too much money out there. There's not enough things to buy. So the things that are available, the price goes up. A great example of this right now is the housing market. Right now, there is a shortage of supply of available houses. There's just not enough houses being built, and there's not enough inventory from existing houses like the one that you live in if you decided to sell it. And so prices are rising very, very quickly. And it's creating a very hot property market. We're seeing houses sell for amounts that we never thought that they would sell for, especially in areas around the Cleveland area, Columbus, some of the areas that were most depressed in 2008 are recovering the fastest. So in this case, when prices rise on their own, despite the efforts of the Federal Reserve to keep them low. So the Fed is trying to keep rates low, and they're starting to rise even a little bit more than what they thought. So in general, this is not a good thing. When rates rise because of inflation, it really can hurt the market long term. And we've seen this in the late 60s, early 70s. We saw it in the late 70s when Jimmy Carter was president. Inflation was just crazy. They had mortgages at 15, 16, 17% for a mortgage. I mean, you could get a 30-year mortgage right now for 3%. So imagine if you had to pay 17%, how much less house you would get. So inflation is really an insidious thing. And I want you to think of this because we don't know exactly right now which one of these forces, an improving economy, the COVID recovery is very real. It's happening. There's no doubt about that. That improving economy, jobs increasing, or inflation. And I don't know if you used to watch Saturday morning cartoons when you were a kid. I am 54 years old, so I remember Bugs Bunny and different cartoons and things like that. And inevitably, there'd be a cartoon where on one shoulder, there would be an angel, this little angel, speaking to the cartoon character and saying, here's what you should do. It's the right thing. It's a good thing. Be a better person. And on the other shoulder is a little devil. And that little devil's whispering into the other ear saying, oh, no, do it. You deserve it. Well, I like to think of the interest rate rising almost like these two characters. You got a little angel over here, which is the improving economy and the COVID recovery and jobs coming back. And on this shoulder, you got the little devil. And that little devil represents inflation. And the inflation is a thing which hurts the stock market. It hurts just about everything that we do is going to cost more money. And it's not because you're getting more value. You're actually going to get a lot less value. So in the cartoon, we never really knew which one was going to win out, right? They're both kind of squawking in the ear of the cartoon character. Now, we want this guy to win. We want the angel to win. And in this case, we want this angel to win because it's an improving economy. And we all benefit from an improving economy. We don't know which force is going to prevail as of yet. Now, we are talking about higher taxes. Also inflationary, even though it pulls money out of the economy, money that you can't spend, sends it to the government. The government in turn spends it on a variety of things, most of which we would disagree with. But it is inflationary at its core. And so I don't think we're going to know until January, maybe December or November, but probably January 2022, which force is going to be more prevalent, which force is going to take over. The good angel, which is the improving economy, or this little devil that represents inflation. And I think what we'll be able to tell is fuel prices, fuel and energy, food, fuel, energy. Those are really the three critical things that we all have to have. So as we go into the summer, the South, the Southeast, the Southwest, they're using megawatts of electricity on air conditioning. What are energy prices going to look like? And then going into the winter again, into the fall, and I know we're not even into summer yet, and I'm already talking about next winter, but energy prices in the Northeast for fuel, for natural gas, for things like that, that will be the first, I think, telltale sign outside of housing that we have inflation. Now, if we have inflation and it's starting to run on us, the Fed's going to have to act. They're going to have to move rates a little faster than what they thought. And what that does to us is we now have to rethink these investments that we have that are in SPACs and some of these high-flying ETFs and stocks, because they're all living on borrowed money. And if they see inflation, their cost of doing business just went up exponentially. And so you'll see some of those trades come off. So as the summer continues, what I'm evaluating is which one of these cartoon characters is going to win, the angel or the devil. Improving economy, jobs coming back, expanding economy in a lot of ways, or the devil, which is inflation, that's a market killer. So we have to be cognizant of these things. Of course, we just sent out a quarterly newsletter. If you want to be on that newsletter and you're not a client, all clients are on it automatically. If you're not a client and you want to be on it, email joshua@epsf.com. It'll be right here. Also, if you have questions for the podcast, joshua@epsf.com. We love to answer listener questions. We're available on Apple Podcasts now, on YouTube, Spotify. Are we available on Spotify? On Spotify. So you can go to Apple Podcasts and subscribe. You could do that at YouTube also. Probably Spotify or subscription services. So subscribe, send it out to friends, get on our newsletter. That comes out at the very least quarterly, and sometimes more if there's a market event that we need to talk about, or an election or something like that. So we're going to see a lot of news coming out. We want to be on top of that. As we reevaluate portfolios, I want you to be in the loop, and I want you to know what we're thinking so that if there are moves in your portfolio, you'll understand it. As always, if you have questions, reach out to us. We love to answer questions. I'm David Safransky. This is Financial Revelations, and thank you for listening.